All right, so as folks are joining, we'll give you about 60 seconds to hop in before we start the presentation. So welcome to part two. Again, thanks everyone for joining. We'll start here in about 30 seconds. We'll let people continue to join and get settled. All right, guys, maybe we go ahead and get started. Will and Dan and team. So welcome everyone to the to part two of the Industry Expert Forum, the Audiology Industry Trends for 2024. Glad to have many of you back for session number two. We go to the next slide, Will. All right, so again, for those of you that didn't get a chance to check out part one, we covered a lot, unveiling the macro and industry trends. Dan and I shared, with Will, shared a ton of data on what's happening in the marketplace as far as Medicare Part D, Medicare Advantage, sorry about that. Also, we spoke about OTC trends, also just things that we're seeing generally in the marketplace. Today, with part two, though, we're going to dive really deep into the numbers and really start looking at those industry trends at the clinic level with specific clinic KPIs provided by MVP. Next slide, Will. So again, my name is Michael Guyton. I'm the Vice President of Sales for Signia. Also joining us on this call today and presenting is Will Dowes. He's a HIS and practice consultant with Pivot Hearing. And also will be joining us Dan Quall, audiologist. He's Director of Strategic Initiatives for Fuel Medical Group. So I have to get some of the legal pieces out. I'm an employee of WS Audiology. Then I derive revenue through the wholesale distribution of hearing aids. Dan is part of the Fuel Medical Group, and he derives his revenue through the wholesale distribution of hearing aids. And Will Dowes is employed by Kenwood Hearing Centers, Pivot Hearing, and MVP, and they derive their revenue through the retail and wholesale distribution of hearing aids as well as software subscription sales. So the data we're going to be presenting today, many of this comes from HI statistics that's publicly available. Also, there's a ton of MVP data. So My Vitals portal is a business intelligence tool powered by data from over 750 audiology clinics. And then there's also data from CMS.gov on the Medicare Advantage plans. But one of the things that we're really going to dive into, Will, maybe before you jump into your KPIs and presentation, maybe share with the group the number of clinics that are represented as far as unit wise, for this presentation.
Yeah, absolutely. So right now we're on pace to see something like 130,000 private pay hearing aid transactions this year, 2024, and another 60,000 or so third party. So yeah, approaching 200,000 total hearing aids.
So great sample size.
And add on, Will, we're looking at this data over a 5-year trend, 2018 forward. And so you can, you start looking at how many transactions that is. If you're just looking at your annual transactions that you just quoted, we have a significant amount of information here.
Yeah, absolutely. So as Will jumps into the presentation, for those of you that have questions, please put those in the chat. We do have time set aside at the end where we will get to those questions. So with that, I'll turn it over to Will and Dan.
Awesome. Thanks, Michael. Yeah, so just to quickly review what we talked about last week, we covered Medicare Advantage enrollment and how that's growing rapidly over the last several years, with 2024 being the first year where it finally surpassed traditional Medicare. So that means more than 50% of Medicare eligible are in a Medicare Advantage plan. And we know that it's a regional issue, at least somewhat, although just about every part of the country has been impacted. But if we look at 2018, we can see the green are counties that are less than 20%, red, greater than 50% Medicare Advantage, just to get a look at what it looked like in 2018 versus what it looks like as of this most recent open enrollment period, which just ended. So a whole bunch more red, particularly on the eastern third of the United States. And we established that the impact that this has had on the private pay units and third-party units, we're still seeing growth in the private pay side of the business, and the absolute number of units is greater still. But when you look at the average annual growth rates at 37% on the third-party side versus 9% on the private pay, it means that segment, the third-party segment, is growing 4 times as quickly. So something definitely that we're seeing, and today we're going to look at what that kind of impact that's had on clinics.
Yeah, I think it's also important to note that even though it's 37% growth on that side, it still represents in this cohort of clinics that we're looking at roughly a little over 30% of the products that are being dispensed on a daily basis in each of the clinics.
Yeah, absolutely. It's right around 30% of all the units we're seeing as of the last 12 months or so. Okay, so the first thing we wanted to look at to kind of understand the impact that this might have had, this big kind of fundamental change has had, is to look at average selling price. And when we're looking at average selling price, ASP, for private pay, it's not particularly interesting, in my opinion, unless we also understand the technology level, the product mix that's going into that calculation. Because obviously premium products are going to have a higher price than entry or basic. And if we look at the chart at the top of the screen, we can see that premium hearing aids as a percentage of the total have been growing considerably year over year, all the way up to, what we've seen so far in 2024, that it's approximately 50% of all the units, private pay units, that we can see. So with that pretty big shift, you would expect, or at least I would have expected, more ASP growth than what we're seeing on the chart below, which is showing a steady increase in average selling price on the private pay side, albeit fairly modest. And if you think about a couple other things that have taken place, we've seen, several rounds of manufacturer price increases, along with, kind of historical levels of inflation, which have impacted every segment of running a business. Everything's more expensive than it used to be. So given all that, this ASP growth is a little lower than we would have expected. And if we break it out a little bit differently here.
Well, before we jump off of this slide, I want a couple of things I wanted to note here. Well, so first of all, when you look at that average sale price, and I go back and I've been benchmarking and looking at practices for a long time, data that came out, it was in 2015 or 16, the ASP, and it was through the study. I don't know if it was Signia that was involved, but it showed an average sale price of around just shy of $2,200 per unit. And so when you go back even that far, and then you look at where we're at today, that is a really insignificant increase. Now, this data has been validated. There was a great paper done by Amin Amlani that you can look at that looked at costs, and he was showing the value that's increased with high-end units because the prices haven't gone up. And you look at the relative inflation factors, we really have seen a decreased out-of-pocket cost to the patient relative to everything else in the marketplace. So I was very surprised, of course, to see this trend, particularly given the manufacturers' increases. And I think one of the things that jumps out at me is the fact that as practice owners, have we taken the time to really look at our price increases to our consumers? We've all been faced with it, and none of us want to have to go out and compete in that side of the market. But certainly, we have to take a look at that from a standpoint of our products and our margins. So I think this is where you're going next.
Yeah, absolutely. Yeah. So when we look at the ASP broken out into a couple different categories, so on the chart below now, you've got the total ASP in the purple, the premium product ASP, and the non-premium products, just to kind of look at the categories separately. That the purple line represents the modest growth we saw in the previous chart. But if you look at the ASP on the premium and the non-premium, it's essentially they're flat lines. So they have not changed fundamentally since 2018. So whatever ASP growth we are seeing is driven strictly by the top chart, which shows the increase in premium as a percentage of the total. Products themselves, the ASPs are not changing. It's just more and more high-end products, which is also an interesting trend. Premium products are available through many managed care programs. Big box stores even are offering products in that segment of that type of technology. So that's putting some pressure on private practices likely to have to offer to compete in that space. So
it's the downward pressure of pricing in the marketplace is what you're saying.
Yes. So we also looked at fitting fees by year, and we wanted to kind of see how that was changing. And perhaps unsurprisingly, we've seen a downward trend in that particular metric. So on average, the per unit reimbursements for fitting fees are going down. And much like technology levels are a really important thing to consider when looking at ASPs, I think it's important to look at which TPAs are responsible for these trends. So we looked at the number of third-party units by third-party company, managed care company, and we can see as a percentage of the total. So we can see some interesting trends just at a glance here. We can see that True Hearing appears to, at least in our data set, be decreasing a bit with UHC clearly taking off in recent years. So UHC kind of stands out as the third party with the most growth. So you would think that whatever's happening there is having a large impact on the overall numbers.
Yeah, I think the other thing I wanted to bring up on this slide, Will, is the fact that you see a number of different players down there from Nations Hearing Care Solutions, Amplifone. And so the data up above, when we look at the average fitting fee, this is the pouring all of them in a bucket and stirring it up and pouring it back out and looking at the average. So we have to stop and take a look at, I mean, we're not surprised to see a downward trend. This is what you see in the world of insurance as those businesses try to control their costs and improve their bottom lines. But we've also had more players come in with more different types of programs, and I think that that's creating some downward pressure on the reimbursement levels. But let's go to the next slide and take a look at a little more detail there.
Yeah, absolutely. So the assumption, given what we've seen with UHC going from something like 10% to almost 40% of the units in this period of time, the expectation is that that's going to be responsible for whatever we're seeing in the fitting fees. But ironically, somewhat, the fitting fees on the UHC units is actually increased, or at least the trend has been upwards over the years. Not true in 2023. It looks like it's dropping. And then what we've seen in 2024, even lower still. But if you compare that to all the other third parties, clear downward trend there, which suggests that even though UHC is going up as a percentage of the total, whatever's happening with those other plans is dragging down the aggregate. So I think that speaks to the importance of understanding the differences between these plans, which ones make more sense, how you treat these patients, how you handle them operationally.
Yeah, it certainly highlights the fact that you have to pay attention to the contracts and not just sign up 1 year and then ride it out, have evergreen renewals. You've got to look every year at the new programs that are coming out, the changes in reimbursements, and then make clinical decisions about staying in or out of network.
Absolutely. So in total, when we look at we're looking right now at the blended private pay and third party margin per unit. So how much margin is being generated per unit dispensed? And to calculate that, we have to use a cost of goods sold assumption on the private pay side of the business, where the third-party fitting fees do not have that same issue. There's no COGS there. So we're for the purpose of this calculation and others throughout this presentation, we use 35% as the COGS percentage, which may be higher or lower than what you see in your practice, but that's a reasonably good average. But what we can see here is that a clear downward trend in the total amount of margin being generated per unit dispensed by year over time. Not surprising. The private pay ASP is going up, so that means that whatever we're seeing here is whatever's going on the third party side of the business, whether those the units growing, the reimbursements declining, that is what is responsible for this downward trend in margin per unit.
And I think again, it speaks well to the fact that if clinics are feeling the pressure of shrinking profitability, this is probably where we need to look, is that our margins are shrinking, right? The indications are that the people are coming through the door. Units are up on both the private side as well as the TPA, but certainly the margins are going down. And so as we have to deal with more patients, we're seeing, and may mean more personnel, all of a sudden we're seeing less in our margin per product. So I think we have to spend a lot of time very carefully looking at our clinics and our costs and our pricing to see where we're landing.
Yeah, absolutely. And it'll be interesting to see how that trend continues. But yeah, in general, it's just going to take more patients to generate the same kind of margin than we've historically been accustomed to, which I don't think is surprising to anybody, but it's definitely clear with these numbers here.
Yep.
Okay, so if we look at third-party and private pay transactions or patients, kind of looking at the transactions from an initial sales standpoint, we can see this is an exercise that we've done actually over the last several years, but we're doing it now with actual numbers, which come out of the MVP data set. So it's a little bit more interesting this way. But if we take the average selling price that we see in MVP over the last 12 months, and we apply that 35% cost of goods sold assumption, we come up with something like $1,600 per unit of margin dispensed on the private pay side. 91% is the binaural rate that we see in MVP. So we use that as an ingredient in this calculation. So the math here works out to, on average, something like $2,900 in margin per private pay patient fit with hearing aids. On the third party side of things, we know the average fitting fees lower. I mean, it's lower than the ASP, obviously. It's around $492. There is no cost of goods sold. But assuming the same binaural rate of 91%, that works out to something like $895. So what that means is we calculate this metric called a TPA multiple. And it looks like as of the last 12 months or so, you're going to need about a little over 3 private pay patients, three third-party patients to generate the same margin that you would off of 1 private pay patient. So that's interesting. We've looked at that for a while. That number appears to be increasing a bit, and that's likely.
One of the things we talked about, Will, when we saw this is that, okay, with our private pay patients, because most people, the significant number, are bundled, once they have signed up, the private practice owner or the clinician owes services for a period of time moving forward. Whereas when we look at the TPA, we're assuming most contracts require services for the first year. So certainly they have not collected for services, for years, let's say 2, 3, 4, and moving forward. So that was immediately we looked at that and said, okay, let's take a look at and let's try to understand what happens for collection of revenue, after that first year.
Yeah, absolutely. And it's a reasonable assumption that what you generate on the private pay side initially is, for all intents and purposes, likely what you're going to generate from that patient. You owe them your services now. With the third-party patients, you have the opportunity to generate more revenue over time.
Yep.
So we wanted to look at that and see, okay, well, what in fact has happened? So we looked at a couple of cohorts of patients in the MVP data set to kind of measure this. And what we did was we looked at patients who purchased hearing aids between 2019 and 2021, both in terms of on the private pay side of things and the third party. So it's roughly 140,000 patients on the private pay side and 40,000 on the third party side. So a pretty reasonable sample size here. And we wanted to give patients enough time post sale to really measure the outcomes, the things that happen over the years, because we know patients come in for visits, potentially you generate more revenue, things like that. So in order to measure this, we wanted to give plenty of time. So that's why we picked those years. And if we look at the initial margin per patient for these particular patients, that TPA multiple that we just looked at on the previous screen, it's very similar. It's a little lower here, probably because the ASPs were a little bit lower during this time period and perhaps fitting fees were a bit higher. But if we look at the additional margin per patient, which is the next value down, we can see that the TPA patients did in fact generate more additional margin over time, a little over $100 more. So not huge in absolute terms, but if you look at that as a percentage of the initial margin generated, quite a bit more on the third party side, which is expected because most of the private pay patients in the MVP data set and just generally are offered a bundled hearing aid sale type solution. Interestingly, and perhaps not surprising, but the private pay patients have come in for more visits since their initial sale, with on the private pay side, something like 7.5 and third party, roughly 5.5. So the third party patients are coming in less, which where the rubber meets the road in all of this, in my opinion, is when we look at things down to the clinical hour. So knowing that you generated a bit more margin per patient on the third party side and they came in a little bit less frequently, the margin per hour works out to being something more like 1.8 in terms of that multiple. So 1.8 hours of third-party patient time is equivalent to 1 hour of margin generated on the private pay side. So when you look at the difference between third-party and private pay at the initial sale, how much of that gap in margin can be closed? This seems to suggest that some of it can be, but not entirely. And an interesting piece in all of this, I mentioned it earlier, was the difference in time spent in the clinic. So the question here, TPA patients are have 28% fewer appointments than the private pay patients in the same about at the same time. So what does that mean? The question that comes to mind is which patients are likely hearing better, which patients are more likely to be loyal to the practice, be good ambassadors for your company out in the community. It's an interesting question, and something that definitely stuck out to me when I saw this data.
Yeah, well, I think I'd love, I think all the professionals out there would love to have a discussion about this, because I think this is a pretty significant finding to look at the appointments per patient, because it speaks to, if we're looking at primarily unbundled with our private pay and primarily bundled on our private, unbundled on our TPAs, it starts to speak to, is the reason they're not coming in as frequent because they're having to pay for the appointment and they don't see the value? Is that it? B, is it possible that the providers at the clinic level look at this cohort of patients at a different satisfaction level because they aren't getting paid, and so they're not as focused on them? It certainly raises a lot of key issues, but there's a lot of data in the marketplace that says the more time the professional spends with a patient, the higher the levels of satisfaction are. That's a given from many of the market track studies that were are on the books. And so I think that we can't ignore, or can't, if we're trying to build a practice and we're working in a region and we're seeing TPAs, we can't ignore this data that says these people are coming in less, and start thinking about what it means to try to create programs to get them in more frequently. And then second, we looked at that that additional margin. Clearly, we're starting to see, we see $100 difference there. We're getting $100 more from that patient, which means we are charging for some of the services, but it is significantly lower than I expected. I expected that additional margin per patient to be quite a bit more if professionals across the country were actually charging for the clinical time that these patients are having. So I think it says there's a gap out there. We have to make sure that as professionals, when people get outside of their contracted services, that we start to charge. I think Jerry's going to talk about that on our next session next week.
Yeah, and I would just say that 28% reduction in appointments is something of a catch-22. It makes the margin per clinical hour for third party look better, but yes, what's the cost of those patients not coming in as frequently, in terms of the things that are harder to measure, like satisfaction, how well they're hearing, and things like that. So yeah, it's an interesting,
really interesting. When that popped up, it was like, okay, this is really, really good data.
Yeah, great. Okay. So moving on to a slightly different topic. So one of the was from a slide on our presentation last week around concerns that customers, private practice owners have. One of the concerns that was on there was the difficulty in upgrading existing users. So we wanted to look at that, and we took a look at this. We have this metric in MVP that we can measure. We call it upgrade interval. It's the average amount of time between sales for patients who have upgraded their hearing aids. So basically the age of the hearing aids at the time of upgrade. So we can see on the private pay side of the business, those numbers are in fact steadily increasing year over year consistently. So not huge changes in any of these numbers here, but it does suggest that patients are holding on to their hearing aids a bit longer.
About half a year longer. I think that's more significant than we realized. But yeah, about a half a year longer.
Yeah, it's very interesting, and there's different explanations for why that might be, but it's also a trend that's seen in various consumer electronic products like smartphones and things like that. I think people are holding on to their products a little bit longer than in the past. So yeah, definitely interesting. Yeah.
I just want to talk about that cell phone. So I went in and I looked at cell phone data renewals, and from a macro trend, definitely over the last 5 years, we're seeing people hold on to their cell phones longer. What's really interesting is to look at why they make their changes. And I think it will make us reflect on why people make the changes with the hearing aids. But for cell phones, it's because of usually product function relative to performance. So how long does my battery last? How fast does my system process? And so I think that, as we look at this increased trend time, I don't know that we can speak to it as simply a cost factor. I think we have to start looking at how we're educating our patients and talking to them about the new products, and when we make those recommendations for changes. When does that significant event take place that it's clearly going to create a better hearing situation for the patient?
Yeah, and we also looked at this on for the third party sales as well. And I will say at first glance, this was a bit surprising to see an opposite trend underway here, with shorter intervals all across these years, but also decreasing over time. Kind of interesting. And again, not a clear answer as to why, but my assumption is that this likely has to do with managed care plans that offer zero or little out-of-pocket benefits that renew quite frequently, some as quickly as every 12 months or every calendar year. You can get new low or zero out-of-pocket hearing aids, which could potentially be responsible for those shorter intervals. Now, on the private pay side of things, that's generally speaking a significant out-of-pocket investment for a patient to make. So it would make sense just generally that the third parties might be a bit faster. So a lot of that's going to have to, we'll have to see what happens with these plans over time and how their benefits may or may not change to see if that is in fact what's responsible for it. But it's kind of an interesting data point.
We'll speak quickly about, you and I and Lee actually had the conversation and looked at then the value of a patient over time, again, comparing the two. So we said, well, if they turn them quicker in the TPA interval, what does that mean in additional revenue out of that channel? Is that going to catch it up to the private pay?
Yeah, it's a tricky thing to measure. And one issue there is that the third party business is relatively new. I mean, it's not, it's really ramped up in the last 5 years or so, where the private pay business is much more established. So product purchase cycles and things like that are easier to, or the assumptions are more grounded. So it's something to look at. From what we can see, generally speaking, the percentage of third party patients that upgrade their hearing aids is lower than private pay, but those that do it more frequently.
Yeah. But speak to that, because I think this is really fascinating information. Talk to us about the renewal rates on what percentage of people buy again from the same clinic that you see when you see these repurchases in private pay versus the TPAs.
Yeah, absolutely. It's 30 to 35% on the private pay side, meaning every patient you sell, 1 in 3 or so will repurchase from you again. Doesn't mean they won't repurchase from somebody else or whatever, but the data suggests that we have roughly 1 in 3. And that number is closer to 18 to 20% on the third party side. So 1 out of 5 or so will repurchase, but interestingly, they'll do it faster. So it's something perhaps for a future presentation where we can kind of get at that. Understanding the lifetime value of these patients is something we'd love to.
Right. And again, I want to caution everybody when we're dealing, for example, with that 30% repurchase rate. Remember, this is averages, right? We haven't gone into the quintiles. We haven't looked at means. We haven't looked at any statistically driven data from that side of things. And so obviously some clinics are going to have higher. We have an automatic mortality factor built into our patient base, being that we generally start with them above the age of 65. And so that's definitely going to play into the number of percentage of people that are repurchasing. So, but it's a benchmark. It's something to look at, and I think that's something we'll be digging into at a higher level, certainly in the future.
Absolutely, yeah. So we are almost at time here, so I want to be sensitive to everybody's time here today. So we're gonna work through this last slide here. But what we wanted to do here was we wanted to take a look at the differences between third party and private pay patients in a slightly different way. And we looked at income levels. Now, we don't know the income of any individual patient coming into a clinic. That data is not available, but we do know their zip codes. And with census data, we can calculate the average household income of patients across different groups. And this is really interesting. So what we've seen here is a clear difference in income levels between the private pay patients and third party, again, at the zip code level. But perhaps more interesting than the difference would be the fact that there's appears to be something of a bifurcation in the market, with the third party numbers going down slightly and the private pay number, average household income numbers increasing. So that's interesting. And just to validate this data, we wanted to make sure that we were looking at something that was in fact meaningful. And so we just quickly broke down the incomes of patients who bought premium hearing aids versus non-premium hearing aids. And indeed, you can see that there's a clear difference between the two, which made us feel confident that we were actually looking at meaningful data. But what the top chart tells me is that there is a segment of the market in every region of the country where there are patients who are willing and able to pay for a higher end hearing care experience. And I think that's just really important to know that the private pay side of the business is growing, albeit at a slower rate, but it's still growing. And what we're seeing from the patients that are still in that channel is that they have higher incomes, and that suggests that we think that this is likely a trend that will continue. And it speaks to the viability of this market going forward.
Right. So in other words, when we look forward and we look at this, we say the private pay side of the business is not going away. It is not. There is, we know, overlap in these two areas. We've seen some of our private pay move into the TPA. There's no doubt about that. But there's still a very strong segment of this market in the higher income households that are willing to pay for the premium hearing experience from hearing professionals.
Yeah, absolutely. And that's it. So I think we can
let's go to
move on to Q&A.
Yeah, looks like we just have a couple questions, guys. So Will, I'm going to direct this first one to you. This is speaking to when we were looking at the slide as far as the multiple between private pay and third party. So on the private pay cohort who are being fit with the bundled model, are they being fit with real ear? Why are they coming in so frequently? If they're being fit with real ear measures from the first appointment, I don't see why on average they should be seen for 7.58 appointments. I'm not sure if that data includes whether or not real ear was run, but I'm guessing it's a mix of practices that do and don't.
Yeah, absolutely. No, we don't know whether there was real ear done for any given patient, but in conversations with practice owners, yeah, I would imagine it's something of a mix there. And yeah, that's one way to look at it. Patients that maybe the patients that were real ear fit, their number was lower. Maybe the issue had nothing to do with programming or anything like that. A lot of appointments we see across clinics are cleaning, service, Bluetooth troubleshooting, other things that are programming based. So
this is over what period of time, Will? So if you say 7.58 appointments over, that was from 2019
2019 through yesterday.
Yeah. So clearly, we're not talking about the first year only. So these people are coming in for checkups, all the things that we need to do to manage the patient. So I think the data, I did some studies years ago looking at average hours over time, and the average based on what clinics reported back to us was over a 4-year period of time, they spent almost 8 clinical hours with that patient between test, fit, follow-up, and checkups. So I think that 7.58 is I was not surprised to see that number. And I don't think it speaks to not using real ear. I think a better question there would be if we looked at the first year and took a look at people that used real ear, people that didn't, how many appointments were there? That would be a really good question.
Thanks, guys. And then looks like the second one, Dan just hit it on the head. Are we charging for all we do for TPN patients, or are we limiting ourselves to what the TPN pays? I'll actually comment on this one because this is kind of teeing up what we're going to get into next week as far as things you can implement in your practice, to maintain both efficiency and profitability as we see managed care trends continue to rise. One of the biggest misconceptions you'll probably see with your managed care patients is they think I have a managed care plan, so I get everything for nothing. But we know that's not the case, but we need to be diligent about okay, what exactly does their plan stipulate that is covered, that they do get, and those are the services included. But then what's everything else that you do in practice, the other services that you provide for those patients, and are those things that you can charge additionally for? So those are some things we'll explore next week.
Yep. And I think that they're, you know, from my experience working with clinics and going into clinics and talking to the providers, you know, particularly if it's not the business owner, it's really easy to not charge as the patient walks out the door. I think there's a significant amount of money that is not being collected for professional services on the TPA side of the business that are clearly services outside the contracted services. So yeah, I think it's a big opportunity.
And then one more question that popped up here. So you mentioned that the private pay segment is not going away, but during the last webinar, it was said that the private pay segment is the fastest shrinking. Please address. I don't know, Dan or Michael, if one of you want to tackle that one.
Yeah, man, I can start. Yeah, the data does show, you know, just from what we presented last week, that it is shrinking. But I think the important thing that we have to remember is we're still only hitting about 30% of the folks with a hearing loss. Not all of those folks that are still out there in need have a hearing benefit. So as Will was showing, we know that those folks that are coming from higher income, you know, populations, you know, they're buying, you know, through the private pay, you know, segment. They're not using any type of benefit, or they don't have a benefit. So yeah, while we do see it shrinking from the slides that we presented, we don't think it's going to go away. I just don't see that happening.
Right.
Dan, anything else you would add?
Yeah, I think we also have to look at you know, it's shrinking because when we look at those channels, it's who's purchasing the hearing aids. So if we go back, you know, 10 years and say who was buying all the hearing aids, we didn't have as many TPAs, you know, purchasing the hearing aids for the patients. They were all buying them from us, even if they were under a healthcare contract. Maybe they had a hearing benefit with the Teachers Association, right? And so we still ordered and controlled that hearing aid, and it was counted as a product through that channel. Well, those are starting to go away. And yes, the channel is shrinking, but that just means more hearing aids are being purchased through those other channels. We probably should look at those channels and say how many units are going through each of those channels. And that would be one to say that the units moving through the TPA is growing at a faster rate, more units. If we looked at the independent, it's probably still not less units. It's just on a percentage basis, it's the fastest shrinking.
Yeah.
So I think we have to look at percentages versus actual units.
Mm-hmm.
If that makes sense.
No, it makes great sense, Dan. Yeah, I mean, I still think there's a tremendous opportunity out there, you know, within the independent segment or private pay, you know, how we would describe it here, you know, and even when we were looking at the OTC data, you know, the number of patients that are coming in, the age that they're coming in at, you know, and when you look at that in comparison to what we talked about as far as Medicare Advantage, these patients are way younger. So the likelihood of a benefit is probably not as high. So they're coming in, you know, eyes wide open, you know, and those are those great opportunities to continue to sell to them privately.
Absolutely. Yeah, I think there's a great opportunity out there. I think that that's clearly not going away. I mean, we can look at other professions too to see the same thing. Even look at the medical profession and look at, you know, the way some of them are moving to the concierge type services, and I think that speaks to a cohort of consumers that are really looking for the best experience. And I think that one thing that we've proven in the industry that the professionals are best suited to make sure that they deliver that high quality experience. So,
absolutely.
Looking forward to next week. We'll start looking at you know, more specific things to focus in at the clinic level to grow the business.
Yeah, thanks everyone. We'll see you next Thursday.
Thanks, everybody.
Thank you.